Ladies and gentlemen, today I want to take you on a journey through time, a journey that unveils the hidden pattern behind every major economic reset since 1929. I call it the six-stage collapse. And understanding this is not just about predicting crisis, it's about mastering the game of resilience, strategy, and foresight. Imagine standing at the edge of history and seeing the exact footsteps that economies, markets, and nations have taken when the ground beneath them began to shake. Stage 1 is euphoria, where optimism blinds even the most cautious minds. Everyone believes the boom will last forever, but, my friends, the seeds of collapse are quietly being sown. Stage 2 is debt expansion, borrowing spirals, leverage skyrockets, and risk becomes invisible to those intoxicated by growth. Stage 3 is liquidity stress, where cracks begin to appear, banks, businesses, and governments start feeling the strain, but panic is still simmering beneath the surface. Stage 4 is market shock, the first wake-up call that rattles confidence, sending portfolios tumbling and economies teetering on the edge. Stage 5, policy overreach, is where interventions try to patch the cracks, but often accelerate the collapse rather than prevent it. And finally, Stage 6 is reset, the moment where the old order collapses and a new one is born, a painful but powerful opportunity for those prepared. Here's the hook: every single global reset, from the Great Depression of 1929 to the 2008 financial crisis and even modern market meltdowns, follows this same exact six-stage script. This isn't coincidence. This is history teaching us, warning us, guiding us. The lesson is simple: awareness is power. If you recognize the stage we are in today, you can not only protect yourself, but position yourself to thrive when others panic. You can make strategic moves that transform uncertainty into opportunity. Imagine looking at fear and chaos and smiling because you know the pattern, because you know the path forward. Absolutely! 6-stage collapse framework. 1. Euphoria and overconfidence. Economic cycles often begin with a period of unchecked optimism. Investors, consumers, and policymakers believe growth is permanent, leading to overvaluation in assets and excessive risk-taking. This stage sets the psychological foundation for a future collapse, as optimism blinds participants to mounting vulnerabilities. 2. Debt accumulation and leverage expansion. As confidence grows, borrowing accelerates, both in private and public sectors. Corporations take on excessive leverage, households increase consumption through credit, and governments expand fiscal deficits. This creates a fragile financial structure where even minor shocks can trigger systemic stress. 3. Liquidity strains and early warning signs. The cracks begin to appear. Financial institutions face cash flow issues, market liquidity tightens, and credit conditions become constrained. Warning indicators emerge, such as rising interest spreads, declining corporate earnings, or asset sell-offs, signaling the economy is approaching a tipping point. 4. Market shock and volatility spike. A triggering event, whether a financial, geopolitical, or policy shock, sparks panic. Stock markets, bond markets, and commodities experience heightened volatility. Investor confidence collapses, liquidity evaporates rapidly, and contagion spreads across sectors, exposing the vulnerability created in earlier stages. 5. Policy overreach intervention consequences. Governments and central banks respond with aggressive fiscal and monetary measures. While intended to stabilize, these interventions often exacerbate imbalances, distort market signals, and delay necessary corrections, intensifying the eventual systemic reset. 6. Economic reset and opportunity emergence. The final stage is a comprehensive economic reset. Over-leveraged institutions restructure, markets reprice, and inefficient practices are eliminated. For the prepared and informed, this stage presents unprecedented opportunities to invest, innovate, and thrive while others are still reacting to the crisis. Once euphoria sets the stage, the next act unfolds quietly but powerfully. Debt accumulation and leverage expansion. It begins subtly, almost imperceptibly, as corporations, households, and governments grow increasingly confident in their ability to ride the wave of growth. The hook here is that borrowing feels like empowerment rather than risk. Companies take on massive loans to expand operations, confident that revenues will continue to climb. Investors leverage their positions, convinced that markets will reward risk with ever greater returns. Households stretch their credit limits to purchase homes, cars, and luxuries, believing that today's gains will cover tomorrow's obligations. Governments, fueled by the illusion of endless growth, issue bonds and expand fiscal spending, convinced that deficits are temporary and manageable. Debt is no longer a tool, it becomes a driver of growth, a measure of status, and a source of collective confidence. Yet beneath this veneer of strength, fragility builds. Every borrowed dollar adds weight to an invisible structure, and the higher the leverage, the greater the vulnerability to even minor shocks. Small disturbances, a drop in corporate earnings, a rise in interest rates, or a shift in consumer sentiment, can ripple through the system with disproportionate force. History repeatedly confirms this pattern. In the 1920s, easy credit a stock market frenzy, and investors borrowed heavily on margin, creating a fragile bubble. In the lead-up to the 2008 financial crisis, households and banks accumulated mortgage debt with reckless optimism, convinced that real estate prices would never decline. Even today, global economies show signs of similar pressures, as debt levels in both private and public sectors reach historic highs. The real hook is that leverage is invisible in times of optimism. While everyone is focused on growth, the silent accumulation of obligations sets the stage for a dramatic unraveling. The key is that leverage magnifies both gains and losses, and the more pervasive it becomes, the more catastrophic the eventual correction. Those who understand this pattern can see beyond the surface of prosperity, recognizing that excessive debt is not just a financial metric, it is a warning signal, a pulse of vulnerability that, when ignored, transforms a temporary slowdown into a systemic collapse. Recognizing leverage is not about fear, it is about insight, strategy, and positioning oneself to survive and thrive while others scramble in the chaos that inevitably follows. As debt quietly expands, the cracks in the financial system begin to show, ushering in a stage often overlooked but critical liquidity strains and early warning signals. This stage is subtle, almost invisible to those swept up in euphoria and overconfidence, yet it carries a powerful message for those who pay attention. The hook lies in the paradox that the signs of danger are present even as markets appear stable. Banks and financial institutions start facing cash flow pressures, lines of credit tighten, and short-term funding becomes harder to secure. Companies, previously confident in their growth projections, struggle to meet obligations, revealing vulnerabilities that were hidden behind layers of borrowed capital. Investors notice spreads widening, asset prices wobbling, and sudden shifts in market sentiment, yet these warnings are often dismissed as temporary fluctuations. Liquidity is the lifeblood of financial markets, and when it starts to EB, even small shocks can cascade rapidly through the system. History shows that these early warning signs are remarkably consistent across crises. Before the 1929 crash, banks experienced runs that went largely unnoticed by the general public. Yet these events signaled the fragility underlying the roaring economy. In 2008, subtle signals such as rising mortgage delinquencies and interbank lending pressures foreshadowed a financial tsunami, but many failed to act until panic became unavoidable. The hook is that awareness during this stage is a competitive advantage. Those who read the signals can prepare, diversify, and protect themselves before the storm hits. Liquidity strains also test confidence, exposing weaknesses in both risk management and human behavior. Panic is rarely immediate, but the tension begins to build as market participants sense that something is amiss. Governments and regulators may intervene at this stage, attempting to restore stability, but these efforts are often temporary fixes that delay recognition of systemic risks. Understanding liquidity is more than an academic exercise. It is about recognizing the fragility hidden beneath apparent strength and preparing for the moments when pressure turns into action. For investors, policymakers, and ordinary citizens alike, this stage is a signal that caution, strategic repositioning, and clarity of thought are invaluable tools. The subtle warning pulses through markets quietly, yet ignoring it can turn manageable risks into catastrophic consequences. And those who see it early are the ones who can navigate chaos, while others are caught off guard. Once liquidity strains surface, the economy enters a stage that is both dramatic and unavoidable market shock and volatility spike. This is the moment when tension built over months or years erupts into visible turmoil, shaking confidence across every sector. The hook is that this stage feels sudden, but it is the inevitable result of the hidden pressures accumulating in previous phases. Stock markets swing violently, bonds wobble, commodities fluctuate wildly, and investor sentiment shifts from optimism to fear almost overnight. Portfolios that once seemed rock solid begin to unravel as even minor negative news triggers outsized reactions. The interconnectedness of modern markets amplifies these effects, turning localized problems into global tremors. History has demonstrated this pattern with uncanny consistency. The 1929 crash erupted after a period of euphoria and leverage, and a few initial sell, offs triggered a panic that cascaded throughout the financial system. In 2008, the collapse of Lehman Brothers ignited a domino effect, spreading fear and uncertainty across banking, housing, and international markets. The hook here is that volatility is both a symptom and a magnifier. It reflects the fragility built in earlier stages and accelerates the collapse of confidence, making recovery more difficult. Market participants who fail to recognize this stage often respond emotionally, selling in panic or doubling down recklessly, both of which exacerbate losses. Yet for those prepared, this stage offers unparalleled opportunities. Volatility reveals mispricing, highlights vulnerabilities in competitors or sectors, and signals where strategic moves can yield outsized gains. Policymakers scramble to calm markets, but interventions often struggle to restore confidence immediately, as fear spreads faster than reason. The psychological impact of this stage cannot be understated. Humans react to fear more intensely than to logic, creating self-reinforcing cycles that deepen market instability. Recognizing a market shock is not just about watching charts or tracking indices. It is about understanding the underlying forces that precipitate these movements and positioning oneself to act decisively while others react emotionally. The hook for forward-thinking investors is that every spike in volatility is a signal, a moment to analyze, adapt, and potentially seize opportunities hidden within the chaos. Those who see the patterns beneath the noise are the ones who can not only survive the storm, but emerge stronger when calm returns, transforming fear into strategic advantage. As markets reel from volatility and shocks, governments and central banks step into the spotlight, ushering in a stage known as policy overreach and intervention. The hook here is that while these measures are intended to stabilize the economy, they often carry unintended consequences that accelerate the very problems they aim to solve. Interest rates are slashed. Quantitative easing floods the financial system with liquidity, and fiscal stimulus packages expand at unprecedented levels. The public sees decisive action and feels reassured, yet beneath the surface, imbalances deepen. Interventions distort market signals, encouraging risk-taking while masking underlying weaknesses. Investors and corporations begin to rely on these policies as a safety net, further increasing leverage and exposure to systemic risks. History shows this dynamic repeatedly. During the Great Depression, early government interventions were well-intentioned but sometimes delayed or misdirected, prolonging uncertainty. In the aftermath of the 2008 crisis, central banks poured trillions into markets, preventing immediate collapse but also fueling asset bubbles and shifting risks into less transparent corners of the financial system. The hook lies in understanding that policy overreach is a double-edged sword. It can create a sense of security, yet simultaneously inflate the fragility of the system. For those watching closely, these interventions are signals, revealing both where risks are concentrated and where opportunities may arise once the temporary calm ends. Human behavior interacts with policy in powerful ways. Confidence surges when actions are perceived as decisive, yet when policies fail to address the root causes, frustration and panic eventually return, often with amplified intensity. Markets may stabilize temporarily, but the structural vulnerabilities remain, waiting for the next trigger. Savvy investors and leaders recognize that policy overreach is a moment to step back and assess, not to blindly follow the herd. The hook is that every intervention provides a lens into the priorities, weaknesses, and blind spots of governments and institutions, offering insight into where value can be preserved and where strategic repositioning can occur. Recognizing the nuances of this stage allows those prepared to navigate a period of apparent stability without being lulled into complacency, understanding that temporary reprieves are not permanent solutions. Interventions are not failures in themselves. They are signals, cues to interpret, and opportunities to anticipate the continuation of the cycle, turning the chaos of policy overreach into actionable insight and advantage for those who study history and market behavior with rigor and discipline. After euphoria, debt accumulation, liquidity strains, market shocks, and policy overreach, the economy finally reaches the stage known as the reset, a moment of reckoning where old structures collapse and new opportunities emerge. The hook is that while this stage is often feared, it is simultaneously the most transformative and powerful period for those who are prepared. Markets are restructured, failing institutions are liquidated or reorganized, and over-leveraged positions are cleared, creating a cleaner, more sustainable foundation for growth. This stage is not just about destruction. It is about reallocation of resources, correction of inefficiencies, and the birth of new economic paradigms. History shows that the reset is both inevitable and cyclical. After the 1929 crash, the Great Depression forced innovation in financial regulation and business practices, laying the groundwork for decades of eventual recovery and growth. Following the 2008 financial crisis, global markets, banking systems, and governments were reformed, and investors who understood the pattern positioned themselves to capitalize on the rebound. The hook here is that every reset contains hidden opportunities, often disguised as chaos and fear. For those observing carefully, market prices, distressed assets, and policy shifts provide signals about where value is emerging and where strategic advantages can be seized. The psychological dimension of the reset is equally critical. Panic, uncertainty, and fear dominate sentiment, but these emotions are the very tools that can create advantage for the informed. Those who act decisively, maintain discipline, and interpret historical patterns can enter markets at the point of maximum opportunity, when others are paralyzed by the magnitude of change. The reset is also a teacher. It reinforces the lessons of prudence, the dangers of overconfidence, and the power of preparation. Those who have tracked the earlier stages, euphoria, leverage, liquidity strains, shocks, and interventions, can anticipate the trajectory and act with clarity rather than reaction. The hook is clear. Crises are not simply to be survived, they are to be read, understood, and leveraged. Every reset resets more than markets. It resets mindset, strategy, and positioning for the next cycle. Individuals, institutions, and nations that embrace the patterns of history and respond with foresight can emerge not only intact but stronger, with opportunities that are unavailable to those blinded by panic or denial. The reset transforms uncertainty into advantage, and in this stage, visionaries distinguish themselves from spectators, turning the end of one cycle into the beginning of unprecedented potential. So, I challenge each of you to embrace this knowledge, to study history with intention, and to prepare not with anxiety, but with confidence. The six-stage collapse is not a prophecy, it's a map. And when you learn to read it, when you learn to act with foresight, you no longer wait for the reset, you lead through it. Remember, every crisis contains the seed of massive opportunity for those ready to see it. Take this insight, apply it, and watch how your vision and strategy can turn even the darkest economic storms into the most transformative chapters of your life. The past has written the pattern. Now it's your turn to write your future.